Hello and thank you for joining me for this brief but very important interest rate update for AT&T employees. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group, and we're going to give you an update on where the October interest rates are coming in for 2022 and how that may affect your lump sum calculations between 2022 and 2023. Before I get started, I just want to remind everybody who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. And we've been doing this for about 30 years, and for that 30-year period, we've been working with AT&T employees. So that gives us a very deep understanding of your benefits plans, whether it be the pension, which we'll talk about today, the 401k, healthcare retiree medical benefits, things like that as well. So any questions you have, feel free to reach out and give us a call, and we'll be happy to help you out with that review. Now we do have offices throughout the country, so rest assured if you still need to sit down with somebody face to face, that can probably be accommodated. However, we can talk with you via web meetings, phone calls, email, whatever is going to be the most convenient for you. And if you haven't done so already, or it's been maybe a year or more since you've done one with us, definitely take us up on our complimentary cash flow analysis. This is really the only way to truly determine when's the best day to retire and figure out, okay, based upon what I've saved, what I need to spend in retirement, what I want to spend in retirement, am I on the right path? Can I retire this year, or do I need to work another 2 or 3 more years? I was thinking about retiring in 3 years. Could I retire sooner based upon interest rate changes? We can go through all those different scenarios with you, but that's the best way to kind of show you on paper, side by side, what your options look like, not just now, but in 10, 20, 30 years down the road as well. And that can help you decide on the pension, whether to take the annuity or the lump sum, and the timing of doing that as well. It can also shed some light on medical cost as well. So without further ado, what everybody's kind of curious about and wants to kind of find out is, have we moved again on the interest rate charts? And the answer is unfortunately yes, and quite dramatically. So we take a look at the seesaw pattern here. Just a quick refresher. The AT&T annuity, if it's not the cash balance plan, if it's the regular defined benefit plan, there's a pension calculation method that's used to determine what your single life annuity is going to be for the rest of your life. From there, that's when all the other options take place, whether you look at doing a joint survivor or a period certain, or if you want to take the lump sum. So if you want to take the lump sum, what they do is they take your annuity. Let's say, for instance, it's $3,000 a month for the rest of your life, and let's assume maybe you're 60 years old. They look at longevity tables, and let's assume life expectancy is 86. So they know we have to pay this person, hypothetically, for another 26 years. So they take that $3,000 over that 26-year period, and they do a net present value calculation based upon their current interest rates to find out how much they have to give him or her in order for them to essentially go out and try and recreate that same $3,000 annuity. So what happens is when interest rates are low, kind of like a mortgage, you can afford a bigger house, they have to give you more cash for you to essentially try and recreate your own annuity. Now the flip side is interest rates go up, which they've been going up quite a bit here. That's going to drive down the lump sums, and it's the most dramatic fashion we've ever seen in the history of, the pension plan. Now the interest rates they use actually 3 segment rates. There's the first, second, and third segment. These are the PPA, Pension Protection Act segment rates. The first segment correlates to the first 5 years of retirement. Second segment is going to be for years 6 through 20. And the third segment is for years 21 and beyond. So for most of us, that second segment has a pretty high weighting because it covers 15 years of retirement. Now, as far as the interest rates, what we've seen so far this year, the skyrocketing effect is going to drive down that lump sum for AT&T employees. What they do is they use the November interest rates from the prior year to give you that calculation for the entire following year. So right now for 2022, we're looking at the November 2021 interest rates. And those interest rates now, so far, through October, which came out this morning, jumped again. And they're actually at, let me kind of zoom in here so everybody can see it. They are now at 5.1% for the first segment, 5.83% for the second, 5.68% for the third. If you look at these numbers in red, this is how much it's changed since last November, up over 4%, over 3%, and about 2.6%. So what does this actually mean for me? What happens is roughly, with look at that seesaw again, about a 1% change in interest rates usually equals anywhere from an 8 to a 12% change in your lump sum, all dependent upon your age. So for simple math, let's just assume 1% equals 10%. So in this scenario, if we look at that second segment coming up by over 3%, that means we're seeing probably roughly about a 30%, in some cases higher, drop in your lump sum from this year to next year. So if you ran the numbers and you had a $500,000 lump sum for 2022, and then you looked at commencing benefits in January instead, after these interest rates changed, that could drop down to about $350,000 or so. $1 million could drop by over $300,000. So it's definitely some real money to be concerned about. Now the conversation kind of goes about, figuring out when is your retirement time frame. If you're thinking about retiring this year or next year, or maybe even in 2 years, and you were thinking about taking the lump sum, then it's really important to go and review this, especially as we approach the end of the year, because what's going to happen is if you have that drop, let's say of $200,000, and let's assume maybe you make $115,000 a year. What that means is if you hung on and you want to take the lump sum, and let's say you worked another year, you're working for free. If you work for 2 years, you're working for a little bit of pay because your total pay might be 230 over those 2 year periods, but you might have lost 200,000 in the lump sum. So it's really important to understand this and review it. And again, there are deadlines approaching for many of you. In some cases, you have to commence your benefits by the first of the month, which means December 1st, meaning your last day would be November 30th. Or in some cases, you could go as late as December 30th, having a commencement date of December 31st. So quick kind of history, give you a little bit of chart as to how these rates have moved up, and this is one of the issues with the inflationary pressure we've had so far in 2022. Let me zoom in here. This goes from December of last year all the way to October right now. That bottom blue line is going to be that first segment, and then the top two are going to be the second and third segment, which are fairly close. But obviously you see that sharp increase at the beginning of the year. Then come about June, July, it kind of capped out at June, then July, August it leveled off. And now we've seen significant increases in September and October. The second segment increased roughly about 60 basis points each time, so we've got over a 1% rise over the last 2 months, which is an additional 10% versus what we were looking at earlier just a couple months ago. Another thing, kind of just quick to kind of put food for thought. So if you have questions about it, we had conversation with everybody about this, and if we're thinking about taking the annuity, we've always said that the interest rates don't affect that annuity, so don't worry about that. You can continue to work if you want to. However, that's slightly changed. Again, the interest rates do not affect the annuity. However, the difference is right now we're at a unique opportunity we've never seen before, in which case if you were to retire in 2022, you're still using the low interest rates, which generates a very high lump sum. Now, the interest rates on the outside, as far as private annuities and insurance companies, have gone up, so they are paying higher annuities than what you would otherwise probably get within the AT&T plan. So you could theoretically take your lump sum, buy your own annuity, and get a better income for the rest of your life, or maybe use a portion of that lump sum. So maybe only you need to take 85 or 90% of it in order to generate the same amount of income over that same time period. So again, very important to kind of just look at all these. There's a lot of moving parts, so if you have any questions, give us a call. We'll do our best to rush and get that cash flow analysis updated for you so you know what your specific situation is. So that being said, again, the best way to tie this in, we can give you a summary, but if you want to dig into your specific numbers, we can walk you through the pension estimator tool, how to actually estimate that, what the collection process is. We've got a couple other webinars on that information. But the best way to show your situation is running that cash flow analysis. Right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about 5 to 10 minutes with us gathering some data from you, we can even do it via email if that's preferred, to give you time to collect it. Once we get that, give us about a week, and we could possibly rush it quicker. But we'll get that cash flow analysis for you to show you what your options are, whether you're looking at retirement now versus 2 years, 3 years, 5 years, and so you can see what those look like side by side as you move forward. So again, it's a quick update, but ultimately just the quick takeaway from here is interest rates are continuing to skyrocket, so it's jeopardizing lump sums quite a bit right now. And on the flip side, even if you were thinking about taking the annuity, it may be worth a review because that annuity payment might come out better, and it has with all the people we've been looking at in the last month or two. Might come out better taking the lump sum and annuitizing. So anybody thinking about retiring the next 2 years and looking at either option, it's really important to give us a call to at least see your numbers. So again, you can reach us at 1-800-900-5867. You can also email us at info@theretirementgroup.com. If you'd like to schedule an appointment with myself or one of the other AT&T Focus advisors, you can hold your cell phone up, use this QR code to get into our calendars. I'll give you a heads up though, most of our calendars, if you go in that process, it may not be about a week before you can book it. So if you want to talk sooner because we're up against some deadlines, give us a call or email us and we'll get you set up with an appointment as soon as we can. And there's also a LinkedIn page there if you want to stay updated on the AT&T specific information we release, different things like webinars, the interest rates, AT&T plan changes, all that's available to you through that LinkedIn page. So again, I want to thank everybody for spending a little bit of time just getting an update here. Again, a quick reminder, the retirement group, Even though we have worked with AT&T folks for about 30 years, we're not endorsed by them, nor are we employed by AT&T. However, if you have any questions and want to run your numbers, just give us a call at 1-800-900-5867. Thank you very much, and we hope you have a great day.